What's up, everybody? Michael Silva here. You're watching the Stock Market Brief Show. The 2023 financial crisis, it's upon us. And here's what you need to know now is what we're going to talk about on today's Stock Market Brief. I didn't get out a weekend recap, so in today's video, be prepared to take some screenshots because I'm going to show you tomorrow's daily expected moves and weekly expected moves. If you don't know what those are, don't worry. I'll talk about them in the show today. If you haven't done so already, make sure to hit that thumbs up. It's greatly appreciated. And subscribe to the channel if you haven't done so already. Let's get into the show. Okay, everybody, welcome back. Now, before we get into the technical aspects and the charts and what it is that I'm looking at, let's talk about a few things over here. There's been a lot of debate whether this is QE, whether this is not QE. And honestly, it comes down to one thing. It's liquidity. That's what we're seeing here. You can see the balance sheet rose by a significant amount. Okay, and you can see this, the discount window. What's taking place here? Well, you're seeing a massive spike in the discount window. And if you look back to the left of the screen, what do you see? Well, it's above the 2008 financial crisis era. And typically when you see access in these type of moves in the discount windows, what comes fairly thereafter? Well, you can see here, banks start to tighten, right? And lending gets tighter. Markets of Mayhem recently tweeted this with this chart, and I'll just read it here. Banks tend to tighten lending standards after having to borrow at the discount window, and I suspect this time will not be any different. The cascade impact in a slowing economy, more difficult business conditions, and a higher amount of unemployment moving forward, which is typically, I mean, that's kind of what we've been saying is going to be taking place as we're moving into a recession. You can see here, this is basically just a big spike in liquidity. I know that a lot of people say, hey, when liquidity hits the system, we can see rapid rises in the markets, and that's always a possibility here. But keep in mind of this sector rotation chart that we've been talking about, the blue is the economic cycle. The orange is the stock market cycle. The stock market cycle typically leads the economic cycle. And you can see here, as we move into full recession, which we don't know whether we're starting here in contractionary or if we're coming more further down here. But what I can show you is this. Typically, the stocks that perform best from a relative basis in the stock market, while we're moving into full recession and the market potentially can bottom out further, we don't know yet, and I'll show you some charts here momentarily, but technology, communication services, discretionary, right? These are typically the leaders, and then it goes into industrials as well. This is the same chart we talked about all through 2021 to 2022, and it told us that, hey, we could be making a turn here to start heading down, and we knew that all of last year and leading up into it. Okay, now we're starting to see this start to perform well. And you can see that simply just by looking at this chart where you can see discretionary communication services and technology are the performers this year so far. And you can see it right here, tech, communication services, discretionary. We'll talk about industrials later because it does actually look like somewhat of an opportunity. So yeah, is a recession coming? Well, guess what? We had the 10s and 2 yield curve inverted for quite some time. This, looks out 6-12 months for a potential recession to come. It's been the leading indicator of all recessions that have taken place. And you can see here, if we look at the 10-year and 3-month, this thing just keeps getting deeper and deeper inverted. It's now at minus 134 basis points. That's another low here in 2023. We also know that bond volatility has been absolutely bonkers. This is time to be very cautious. It's time to be very careful. This is not a time where you want to try to be, tag the exact bottom. This is a time where it's okay if you don't hit the exact bottom in the market, as long as you're protecting your capital and then you catch the moves out of it, the cycle coming out of it, which could, be later down in the expansionary phase. It could be more over here. So, it's a time to be very cautious is what I'm saying, but it doesn't mean that there's not going to present itself with a lot of opportunities. Now, as far as rate hikes go, we do have on Wednesday, we had the Fed interest rate decision. Are they going to pause it completely, or are they going to just keep at it as they've been saying and do 25 basis points? 25 basis points is what the market is projecting here, so it's going to be interesting to see what they come up with. Now, I want to go into some charts here momentarily. I want to just point out, yes, technologies, is typically good, discretionary communication service and industrial. So I want to talk about tech, which is through the Qs, and then also industrials. And I'll show you here, if you just take a look at the Qs, we're in like a 6-week consolidation. So despite seeing this banking crisis take place and even a financial crisis, right, that's I mean, this is huge things that are taking place, like not to be ignored or overlooked at. But you can see, what happens typically when we get a lot of liquidity in the system. What typically is the best performers, and it's usually technology, right? These are typically the growth, and they lead the way. And as you can see here, as it stands at this current moment, right? This can change, but we're just in this bullish consolidation as it stands at this given time. You can see we had about a 2 standard deviation week last week, and now we're just kind of heading sideways over here. So as long as we can hold this level at 285, this is pretty bullish overall. If you take a look at the Dow Jones Industrial Average, we're going to take a look at the diamonds. This is a DIA ETF. You can see here we had this nice coil up over here, and when we broke down, we had a full measured move basically of that breaking down. And where did it come to? It came down to back test this prior downtrend of the bear market. So if this can hold right here, that's pretty bullish here. You can see we're still below a year-to-date anchored VWAP and the month-to-date anchored VWAP, but it's a possibility that we can potentially start heading back up to try and reclaim that prior area up in here, which would be a pretty large move in the Dow Jones Industrial Average. Also to note, we've been very oversold conditions. So this bounce, it could potentially get faded. It could be a fake out. We don't know, but this is not exactly the area where I try to come in and short a lot of things. You can see the RSI here on the bullish percent index. It is in clear oversold conditions. The bullish percent index for the New York Stock Exchange is in very clearly oversold conditions when you look at the RSI. Yes, oversold can stay oversold. Yes, crashes can take place in oversold conditions, but that doesn't change the fact that, hey, we can also get rip your face off rallies in these conditions as well. Okay, so like I said, volatility is here. It's clear. You can see that in Russell volatility being in the 30s. You can see that in the VIX being recently elevated. You can see that in bond market volatility. Here's the BPSX chart, so the S&P 500 bullish percent index. Clearly, it's in oversold conditions. A couple other things I want to mark out here, though, too, if you want to be a little bit more patient, is the NASDAQ summation index still hasn't started making its turn up here, where the parabolic SAR upticks or downticks through it, which tells us, hey, there can be a potential change in trend. The last one we had was here, and that told us a heads-up start that, hey, the market might consolidate, it might pull back, it might do something, and it has done that. The last one prior to that was here in 2023, gave us the heads up notice that we could see a potential change in trend. What I do see here taking place in something like the New York Stock Exchange Summation Index is that we do have a low, another low, and another low, but the internals right here are going a low and a higher low and a higher low. So yes, and this, by the way, is still pointing straight down, so has still some time to turn around, right? And this parabolic SAR has a downtick. So it's in, a potential area where we can see a bounce, but it can also, like I said, turn into a potential dead cat. This is not the exact area where I'd be shorting. I'd be looking to potentially play intraday longs and take advantage of this stock market volatility. And by volatility, you can simply just look at the S&P 500. Options change, so I'm looking at the SPX. Just take a look here. Going into tomorrow, we have a roughly plus or minus $36 move. But just take a look going in later into the week. We have a $74 expected move on the Fed day. Okay, then it goes into $88, $97 by end of week. So we still have about a $100 expected move on the S&P 500, which means it could take us to 4,050, or potentially another 100 points lower at, 3,850. Get ready to screenshot this. This right here is the weekly expected moves that I send this out to the Patreon, my Discord group every week, and I track like 40 products. I added a new column. This is 2 sigma expected moves. So I'll go over this really quick, and then you could screenshot it. So first and foremost, this is where the close of week was right here. That was the close. This is the expected move for the week. This is the upper, okay? This is the lower. This right here is a 2 sigma. So this is basically just this number times 2, okay? You can see 121 times 2 is 242. And this is the upper, and this is the lower expected move for 2 sigma. The reason why we're adding this here, the 2 sigma moves, is because the Qs hit 2 sigma last trading week. So it'd be a good idea just to see and understand where this happens. It's very rare to get outside of 2 sigma, but it has happened in various assets in the past, okay? Let's continue on and look at the daily expected moves. This is also something I've been sharing recently in the Discord channel too as well, but I'll share it here today. S&P 500, the daily close was $39.51, the $37 expected move. Take a look. You can just like screenshot it. The SPY right here, it's looking at plus or minus 3.7. The Qs is 3.26, and you can write down these levels going into tomorrow's trading session. I'll bring you into Bookmap. Bookmap is some incredible software if you are an intraday trader. It allows you to visually see liquidity, and that is incredibly important, right? You can use level 2 data. For me personally, looking at all those numbers flicker on my screen, it's way more difficult than being able to see a heat map. Bookmap itself, they offer my subscribers a discount, and I put a link down below, and I get credit for if you do use that link. So if you do, and if you need help with how to use Bookmap and stuff, Bookmap team is like excellent. They do live streams. It's incredible software. That's all I got to say. 4,000 is going to be a key level to watch, as that liquidity's been there all day. What I want to call out here on the S&P 500 today, as you can see, we had the low to the start of the day. We had a higher low, and then we had a higher low, and then we also had another higher low as price held that daily VWAP, which is now going to be considered the weekly VWAP because the week started today. So this is basically telling me here that bulls are stepping up into and making progress into this area of resistance, this area of liquidity of 4,000. Now, if we add on a couple of other elements, I want to just show you the day closed right here, and all of a sudden, right, futures open up, and we're starting to see a couple of areas of liquidity open up. We have 40.20. This opened up, and this happens to be the upper expected move for the day. And then we also had 39.40 open up, and that is the lower expected move for the day. So if we are bullish, if we're getting above this 4,000 tomorrow, we very well may go play for that 40.20 level. That'd be a key level, key zone to watch, 420 to 430. Now, if we start getting below the week-to-date VWAP, that can be bearish, and that can open the door to the lower expected move and potentially this area of liquidity down here at 39.40. So that is what I'll be looking at going into tomorrow's trading session. If we take a look at the SPY on the daily time frame, we reclaimed the month-to-date anchored VWAP, but remember, we're still below a declining year-to-date anchored VWAP. This channel that we've been trading, right, or tracking, we broke down from it, and now we came back to back test it. So we still have work to do. The bulls should not feel incredibly confident right now, but they should feel at least hopeful. We need to be tactical in how we approach this from the long perspective. Okay, and you can see that here on the 15-minute time frame. What you'll notice is I put the weekly expected move up here and then down here. Those are the upper and lower. And then you have the daily, 390.04 and then 397.44. So I draw it out on my chart. Earlier in today's trading session, we were basically pulling into a key level, right? The level that I was looking at going into the trading session was this. Basically, this was the anchored VWAP from the low of March. I have it for some reason offset here, but it comes to around the same place as the 5-day moving average. And you can see there's a key level here. We had this low and this low. So this, if you are bullish, you want that to hold. Okay, you want that level to hold being bullish. What you're starting to see now is price came down. It bounced off the March low anchored VWAP. It bounced off the March low anchored VWAP. That's positive. The 5-day moving average is starting to turn up, which means this can start turning up too, potentially if we get more volume. Okay, and we're starting to get above the month-to-date anchored VWAP right here. And there's not much overhead resistance overhead. So if we start coming up, we may come in to fill this gap, and then we could potentially go for that daily. So this is actually, like I said, setting up for a bullish move. However, you can also look at this and be like, well, actually, Michael, it might be actually just flagging. And yes, it very well may be just bear flagging. So what would you need to do in this situation? Well, as it's right now, we want to stay above the 5-day moving average. It's starting to incline, so that's bullish. You can at least look for pullbacks and be bullish. But if we start taking out this low, that's when we have to become a little bit more bearish and a little bit more cautious in that current environment. Take a look at one more chart. This is Apple. This is one of the trade ideas I shared on my Discord channel. If you're interested in that, I don't charge a lot. I charge $9 a month, and I give an incredible amount of data for $9 a month. I showed this one the other day, and I was watching for this, and this is a pretty popular chart, but I'll dig into it a little bit more here. There's a clear area of resistance on Apple, right? So the resistance area I highlighted right here, you can see we've acted as resistance right here, We've acted as a resistance here. We came down, right? We're back up. We tested it. Resistance, resistance, resistance. And now we're starting to try to peek our head through. This over here, all this volume, this is the volume profile, okay, volume by price, starting from the very high of 2022, or potentially I think that was the all-time high in Apple. I'd have to look, but I'm pretty sure the 2022 January was the high. Okay, so that's where we're measuring this from, and you can see price is trying to break from this area of liquidity, and you kind of have this, empty area right here, this volume pocket up into this area. So if we start getting a pretty powerful bid back into tech or the industrials, right? Dow Jones Industrials has Apple, it's a part of it. This might open the door for a potential another kind of algorithmic type rally, which we've seen, in the past. And if that's the case, that can potentially open the door to Apple being, trading at 170-ish area up in here. Maybe not a straight line, but that's an opportunity. But when would you get more bearish? Well, I mean, not necessarily bearish, but when would you bail the position? Well, if this low was taken out, I'd probably be a little bit more cautious. Or potentially if you're like, that's too big of a risk for me on my position size, okay, fine. The maybe trail the month-to-day anchored VWAP. It's, dependent on how you would like to, do that. But this right here, it looks like it's trying to break out. Now, one thing I want to call out is the amount of volatility that we have. Breakouts typically get faded and they're a bunch of fake outs. So as everyone and their mom is looking at this specific chart right now, they're like, oh, it's getting ready to break out, we're gonna go. And then watch it just take off and then just dump right back. So if we get a solid breakout, but then it starts taking out these lows, or taking out this low, or potentially this low, yeah, proceed with caution, okay? Because these things can obviously get ripped around, but I like the overall structure of that. I like how we're in very oversold conditions in the market. I like how it's, things are lining up from a sector rotation standpoint over here, how we may be moving into industrials and how it back tested that prior area of resistance, which can become a level of support. So a lot of things are potentially lining up, including the whole liquidity bomb drop that's currently taking place as well. That's all I got for you on today's stock market brief, everybody. Hope you got some screenshots. Hope it helps out in tomorrow's trading session. Like I said, it's a time to be very cautious as this kind of crisis has been unfolding. This is not a time to get cute and funny with your money. It's a time to continue to be strategic and focus on risk first. That's all I got for you. Have a wonderful night.